If you've built a decent property portfolio, you've probably already experienced this. You refinance, you pull equity, and you buy again. Maybe even do a renovation or small development. But eventually, borrowing capacity tightens, projects become more work than they're worth, and the growth starts slowing down.
Most people in Australia, when they invest in property, they usually start off with residential. Most people stop there because when you kind of look at residential property, there's actually not so many ways to do it. When you kind of really look at it, well, what's next?
In this conversation, I sit down with Will Tong from Property Lines, who spent more than 25 years in commercial real estate and has been involved in over 600 deals worth more than $3.5 billion. And what's interesting is that many of the investors he works with today started exactly where you might be right now, highly successful in residential, but wondering just what comes next. So in this episode, we break down why residential investors are moving into commercial property more and more, 3 specific value-add strategies that investors use to increase commercial property value, the biggest mistakes that first-time commercial buyers make when analysing their commercial deals, how one warehouse deal closed in just 4 days and created $1 million in equity value, and what sophisticated investors actually look for when evaluating commercial opportunities. Because once you understand how commercial property really works, you realise it's a completely different game from residential investing.
The great thing about commercial property is that if you know what you're doing, you can...
Let's get into it. Hi, Will. How are you?
Hey, Nick. Great.
That's good. It's good to have you on. Great.
Yeah, thanks for having
coming
me.
out.
Thanks for having me.
No, awesome. So our audience, they haven't met you before. So what I wanted to do was ask you a little bit about Property Lions. What is it you do at Property Lions?
Yeah, so simply said, we focus on commercial properties all across Australia, but we specialize in looking for undervalued opportunities or opportunities with a value add angle to it. I've personally been in commercial property for over 25 years, and I've got a team around me collectively probably been in the industry for over 100 years. So we've got pretty mature.
It's a great team.
Yeah, great team, very mature team. So we basically go and hunt for deals.
Yeah, fantastic. No, that's great. And obviously Australia-wide, we're not just buying in one section, which is cool. I know we've worked on deals together in Brisbane and in Melbourne, and there's been some really good properties. So a bit about you before we talk more about Property Lines. So you've been in real estate now for over 25 years, I think you just said, over 600 deals and over $3.5 billion worth of transactions.
Yeah.
That's a lot. Do you mind telling me, so out of all of those transactions, was there one deal that you've learnt a lot from? Can be a good deal, can be a bad deal. What was the deal that taught you the most?
That's a good question. I think when you're early in your career, I think you learn more in terms of your growth rate is faster. So I think there's a few lessons early in my career which I think really helped me shape my mindset and sort of put me towards the right path. But later in my career, I started learning other lessons, but more sort of around how to deliver things at a higher capacity or higher level. So I think in one of the first commercial property deals that I did was actually a strata office in North Parramatta.
Yeah, right.
Yeah, so not too far from here, and that was my first commercial property deal. And before I got into commercial property, I was in the resi space, and typical resi agents, sometimes you package the deals slightly differently in terms of the way you deliver it and the way you sort of market it. Whereas with commercial property, what I learned through that transaction is that it's very black and white. It's very numbers driven, and so that probably taught me a lot in terms of how to market a commercial property, what KPIs and what things that investors actually focus on, rather than, focusing on the windows and the bench and the bathroom and kitchen.
Aesthetics,
all that type of stuff. It's very numbers driven. It's a business decision. So I think my first commercial property deal opened my eyes to that. And then later on, some of the other deals taught me more negotiation skills and how to structure certain deals to make it worthwhile for both parties. So it's not just about price. a lot of times it's about terms and conditions as well, particularly in commercial property. So yeah, so I mean, those are sort of the key lessons, I would suppose.
Yeah, that's great. That's great. And you did have an exceptional career on the sales side of commercial real estate with some of the biggest firms I've seen, which is awesome. What drove you to launch Property Lions and move to the buy side of commercial property?
Yeah, so interestingly, I launched Property Lions during COVID, right in the middle of COVID.
Got you.
Yeah. So at the time, I was a commission-only sales agent. Which is fine, but then during COVID, because of the lockdowns,
yes,
nobody was doing deals.
Yeah.
So there was a stretch of about 5 or 6 months where I had no income because I wasn't able to go out and inspect properties and do deals because everyone's locked down at home. So I figured, well, if I'm a commission only and I'm not doing deals, I might as well work for myself. And at the time as well, because everyone's in lockdown, there's a huge emphasis on online presence. So everyone was actually, interacting online through social media platforms, Facebook, Instagram, whatever. And I was very fortunate the year before COVID. I learned a lot about Facebook marketing. So I hired a Facebook marketing coach. So I paid him probably about like 10 grand or something like that.
Right.
Yeah, it's quite a lot of money at the time to teach me just Facebook advertising and things like that. The reason I did that was because I just wanted to learn the skill.
Yes.
I didn't expect it to come in handy a year later. So a year later, I figured, well, if I can't go out and inspect properties and I'm on commission only, well, I might as well do my own thing, work for myself and try to sell property via social media or sell properties online. So I launched Property Lions in November 2020. And my first couple of deals were virtually all sold online, sold virtually. There was no inspections, no physical inspections. Everything was basically done either through phone calls or Zoom. And obviously with technology, it's just so easy to get contracts signed digitally now. So that was the reason why I started it. And the other reason also is I turned 40 that year. So I thought to myself, look, I mean, it's probably now or never if I want to do something for myself. So that's sort of the background to it. I've always wanted to have my own business and the opportunity presented itself.
Yeah, that's great. That's great. And the team's grown massively since then.
Yeah.
Lots of transactions, really good work.
Yeah.
Some of the work you do is extremely detailed as well. Like it's very easy to walk in and, this property has a 6% net yield. We'll just buy that one. Client's happy. But you go right into the numbers, all of the due diligence. We're looking at the comparable sales, the comparable rentals. There's so much research that goes into that, which I think is really good. And obviously on the back of getting that research in, that puts you in a very good position to help clients with certain strategies to improve the properties and to make money in commercial real estate. Why are you seeing more residential investors come over to commercial, and what strategies are you helping them implement to improve their portfolios? Yeah,
that's a great question. So I often look at the investor's journey, myself included. I think most people in Australia, at least, when they invest in property, they usually start off with residential because it's obviously easier to understand, lower barrier of entry, et cetera, et cetera. Typically, a residential property investor goes through 3 stages. So the first stage is they'll buy a single dwelling, whether it's a house or an apartment or a townhouse. They borrow against their income, and they buy it and they hope the property price go up because the market's active. And over a period of maybe a couple of years or a few years, they build some equity in that residential property, and then they'll refinance and buy again. So that's kind of stage one. And most investors, they kind of stay there because they run out of borrowing capacity, or they just simply don't have the appetite to do anything more than that, which is totally fine. And then you've got stage 2 for people that are a little bit more hands-on, a little bit more active. They want to fast-pace the equity growth. So they get into some sort of renovation or refurbishment. So buy, an old house in a good location, spend a couple of $100,000 on it, do it up, and they might, sell it and make a couple of $100,000 net profit out of that. And it could be a 6 or 12 months sort of turnaround. So that's kind of stage 2, so that refurbishment or renovation play. And that's great as well. But then typically those people who are doing renovations, they actually get sick of it because they realize there's so much work involved in doing a reno. And they often then go to stage 3, which is becoming a small developer. So they might do a duplex development, or they might do some townhouse, small scale, so townhouse developments. And, they might earn, 15, 20% their margin out of that. Sweet. And most people stop there because when you kind of look at residential property, there's actually not so many ways to do it. I mean, I would include, subdivision and all that in that sort of development stage. But when you kind of really look at it, what else can you do with residential properties? That's kind of the ceiling, unless you become guys like Lend Lease and, stock loans. That's a completely different ballgame, but I'm talking about individual investors. So I think a lot of residential investors are coming to commercial property now because they've hit some sort of ceiling with their residential investment journey, whether it's stage 1, stage 2, or stage 3. They figured that, commercial property can offer a slightly faster outcome. And you will notice, there's a lot of different financing sort of options for commercial property. So if they're maxed out in their borrowing capacity for resi, they can potentially go and buy commercial with a lease stock loan.
That's right.
And all that type of stuff. So the ceiling is a lot higher, or actually there's no ceiling really with commercial property. So that's the reason why they want to go into commercial property, because they want to continue to grow their portfolio, continue to grow their investment journey, but they've hit a ceiling with residential. So a lot of clients that we work with, they fall under that sort of category where they've done a lot of resi, they've hit a ceiling. Well, what's next? And what I find out at least when I started Property Lions, is that there wasn't a lot of companies out there that were servicing the private investors in the commercial property space. So a lot of the big institutions like Colliers and big agencies, big pardon, the Colliers and Knight Frank and GLL, they work a lot of times for the larger institutions like your Stocklands, Dexters, GPTs and things like that, or maybe high net wealth families. But not a lot of them really focus on sort of the middle of the market. So the idea behind Property Lions was I wanted to service the private investors / business owners that don't play in the institutional space, but still want to get into commercial property, but don't know how. So the type of deals that we typically look at are sort of between sort of 5 to 25 million, because that's that kind of mid-tier space. A lot of these investors are coming to commercial property because they see it as a pathway to continue to grow their portfolio. So a lot of them have now sort of sold their resi portfolio, cashed out, and putting all the money into commercial.
Yeah, that makes sense. And there's been some exceptional results with clients that we've worked on together in that bigger space as well. So you can see why someone might gravitate towards commercial property, having that uplift. And there's some other strategies there that people can use. You're working in that 5 to 25 million space, a lot of different types of people. What are the smart investors doing in that space to make a lot of money in commercial property? Yeah,
so the great thing about commercial property is that if you know what you're doing, you can very easily increase the value of the property. And it's a lot more predictable as well, because it's very numbers driven. So the three main strategies that we use, and there's more, but the three main strategies that we use to increase value of a commercial property are a rental reversion, subdivision play, and a refurbishment play. So the properties that we want to buy typically are established properties. So we don't go for greenfield sites. We don't play in the development space because we figured out that if you can apply one of these three, or maybe a combination of these strategies on an established asset, you would actually get better net profit compared to a straight out development with much less risk. So that's another reason why a lot of investors has come to us, because they realize, residential development, on a good day you make a 20% margin.
On a very good day.
On a very good day, right?
Yeah.
But it might take you 2 or 3 years to pull off. Whereas with commercial property, particularly the value adds that we're doing, we're getting at least 20% in most cases, in far less time and with far less risk, because we don't have a development risk associated with it. We're not at the mercy of council for DA approval.
Yeah.
We're not dealing with all these builders and tradies that come and go and jack up the prices. We're playing with tenants that have a fixed lease term, so we know we can predict when the lease expires, and we can sort of work around that. So it's a lot more predictable. So that's why the risk is much lower, but we're getting exactly the same, if not better, net profit than a typical resi development.
Yeah, it's fantastic. And for someone that's coming into commercial for the first time, they're looking to do a rental reversion or another one of those strategies. What are some of the common hurdles or mistakes that they make when they try to assess it on their own without the help of a professional team?
Yeah, that's really good questions. And I think one of the biggest mistakes that first-time commercial property investors make is they don't know the difference between net and gross rent. So yes, there is a misconception that tenants pay for all the outgoings.
Yeah.
Now, that is majority of the case, but that's not all the case. Particularly we're dealing with retail properties as well, but we won't get into retail. We'll probably just stick with industrial properties because that's just easier to understand.
Yeah.
So typically the tenants would sign a lease, they'll nominate the starting rent, let's call it about 100 grand a year. And then there's the outgoings component. The outgoings component can be negotiated. So what makes up outgoings, right? You've got your statutory rates, council rates, water rates, etc. You've got your insurance, you got your land tax. You've got potentially body corporate if it's strata, management fees, and So there's your typical sort of outgoings. The misconception in the market for first-time commercial investors is that they assume that the tenant pays all the outgoings. So they pay the rent, 100 grand, plus maybe there's 30 grand of outgoings. They assume that the outgoing is covered by the tenant. So when they go and analyze the deal, they make that assumption. But a lot of the times, more often than you think, there are certain outgoings that are negotiated out of the payment on behalf negotiate out of the recoverables from the from the tenant. A real typical one is land tax. So especially the more sophisticated tenants, they will be happy to pay for the outgoings except for the land tax. So they negotiate the exemption out of that. That's number one. And number two, they could also negotiate body corporate fees out of that. And certain items in the outgoings completely out of that. So a lot of first-time property investors, commercial property investors, get caught out because they haven't calculated the right net income. And they've made the assumption based on false evidence. So that's probably the most common one.
Gotcha.
Yeah, so it's really important to go through the lease with a fine-tooth comb. It's really important to hire a good commercial property lawyer that can go through the lease and identify what's actually in the lease. And then the other thing also is, and this is what we do for every property, is you have to do a financial reconciliation. So basically what that means is you have to ask for rental ledgers, you have to ask for invoices for outgoings payments, and then you have to see whether they match up with what the lease says. Because a lot of times it doesn't. And there could be a gap. So you need to question, why is there a gap? So a quick example, we were looking at this property in Brisbane a couple of years ago. You were helping me out with the finance at the time. And the property was self-managed by the previous owner. And a lot of times these self-managed properties, they make mistakes in the calculations, right? It happens all the time. The most common one that I see is the CPI increases, right? So the lease says this lease is subject to CPI increases. Okay, great. sounds pretty simple, but the owner might grab the wrong CPI number.
Gotcha.
Right? So maybe it should have been a 5% increase, but they grabbed the wrong number and only applied a 4% increase. Right? So over a period of time, what you realize is that the tenant should be paying this much by now, but they're only paying this much because the landlords applied the wrong CPI increase. And unless you go back and look at the rental increases from the start of the lease, you might just take their current payment on face value and just think that's what they're paying. Sometimes it works in reverse. So they might be applying too much and the tenant hasn't realized it. That's probably the worst case because you got to pay back rent to the tenant.
Overpay.
Yeah, because if the tenant underpays, that's fine because you can you can recover the shortfall. But if the tenant's been overpaying, then potentially you've inherited liability where you may have to pay back. So you have to do the financial reconciliation properly. And a lot of times you need to trace back all the way to the start of the lease and make sure that all the increases have been applied properly. The tenant's been paying what they're supposed to be paying under the lease, and also the outgoings as well, especially if it's self-managed property and the owner is calculating the outgoings. Again, they might make mistakes. And over time, there could be a 10, 20 grand sort of liability that no one's aware of, that all of a sudden you kind of go, oh, geez, the owner's been overcharging for outgoings or undercharging for outgoings. So those are probably the most common mistakes that I see from first-time commercial property investors. Interesting,
yeah. And I suppose that's where you come into play, helping with the due diligence, connecting people with the professionals to do the review, because I think a lot of people get a little bit upset when they go to try and buy a commercial property, and a lot of the times it is on their own, and they either buy something that has an issue or they come through a firm and the property falls over due to due diligence. But I think when a property falls over in DD, it's the best time for it to fall over, because if we end up buying the asset, we're going to be in a lot more trouble. So I think it's good that you do that thorough review and help people avoid those hurdles. When it comes to some of the clients that you have had success with, which we've worked on quite a few together and they've had some really good successes, do you have a favourite transaction that's occurred that had a really exceptional result that you're quite proud of there?
Yeah, I think there's probably two that comes to mind, and for different reasons. I'll talk about the first one. So the first one I particularly like because we were able to close the deal in 4 business days.
Wow.
Yeah.
Very quick.
So a bit of background. So it's a small warehouse in Dandenong South in Melbourne, southeast Melbourne. It's about a $2.5 million asset. But it was really undervalued because we've been buying properties in that market, so we know the market really, really well. The property should really be worth about 3.5. But because of mismanagement and so forth, the owner was only chasing $2.5 million for it. So we saw that on a Wednesday. So we immediately knew that it was undervalued, but we wasn't quite sure by how much. So we completed the feasibility report by that afternoon. So by Wednesday afternoon, we completed the feasibility. We ran through all the numbers because we have all the data already on Dandenong South because we've been doing that market for so long. So then we realized, actually, it's probably about $1 million undervalued.
Wow.
Yeah. So we then presented the opportunity to a client of ours straight away on Thursday morning. And we said, look, this property you need to jump on and you need to be quick about it because I guarantee you, once we go over the weekend, there's going to be a lot more eyes on the property and potentially we're going to miss out because someone's probably going to come in and just buy it off us, buy it and snatch it away. So the client was committed to reviewing the information straight away. And then what we also did was we preempted a couple of things. We knew that we still have to complete the DD. So what we did is we spoke to a building inspector that we work with down in Melbourne and said, look, we need to get your team in there ASAP. Like, when are you available? We're happy to pay a little bit more if you guys can get in within the next 24 hours. So thankfully, we have a good relationship with these guys. They said, yep, no worries, we can get in tomorrow, which was Friday. we'll go in and we'll, look at the property and, give you guys a report. Great. And then we spoke to a lawyer that we work with down in Melbourne as well. Again, same thing. Hey, mate, we need a favor. We need you to review this contract in the next 24 hours because we want to do this deal straight away. And he says, all right, no worries. I'll work back a little bit just for you. Fantastic. Thank you so much. And then internally, I got the team to do the financial reconciliation. So by Friday afternoon, we've completed the DD. We've got the rental ledger all reviewed. It was all matched up. The building inspection report was completed and the contract review was completed as well. Thankfully, there was nothing wrong with the building. And the contract was pretty much a template. There was no surprises there. So the last thing for us to do was to fly down to Melbourne and inspect the property in person. So I booked a flight and went down to Melbourne and met the agent Monday morning. And I think the agent was pretty cheeky. He organised 2 other buyers to inspect at the same time. Because I think he realised how how good value this property is. So I said to him, look, we really like the building. We've completed the DD. We're ready to exchange unconditional. What do we need to get this property across the line? At the time, the agent said, well, you know what? We've had a lot of inquiries over the weekend. Exactly what I've predicted. Yep. There's probably 8 or 9 buyers that want to inspect this property. So the owner wants to wait until Friday and let everybody sort of put in their offer by Friday afternoon, and then we'll assess all the offers. In that moment, I knew that if we wait till Friday, we will lose the deal. And all the money that I've spent up front, legal fees and building reports and all that, I spent about $5,000 up front, it would all go to waste. So I knew that we had to get the deal done on Monday, otherwise we would lose the property. So basically I said to the agent, look, we're not going to wait till Friday. We want to buy the property today. What can we do to buy the property today? We're not interested in competing against other buyers. They're just like, oh, well, blah, blah, blah. I said a bunch of things. And then I said to him, because he was from JLL, I said, hey, by the way, so I tried a different tactic. I said, hey, by the way, how's things in JLL right now? I used to work in JLL, 10 years ago, so I kind of pulled that card. So are you guys still on that, crappy commission structure and you guys got to do all these different reporting? Are you still using that CRM system? And he's like, oh yeah. So we started having a chat about his experience at JLL, and it kind of broke the ice a little bit, and he's kind of dropped his guard a little bit. So I was able to build really good rapport with the agent there and there. And I said, look, please go back to the vendor, ask the vendor this question: what would it take for us to exchange contracts this afternoon? He goes, all right, Will, I'll do that for you. So within about 45 minutes, he calls me back. He said, hey, Will, we've advertised the property at 2.5, but if you're happy to pay 2.6, we can get a contract signed today. So brilliant.
No-brainer. Yeah.
Brilliant. Yes, we're paying $100,000 more than the asking price, but we're buying a $3.5 million property. So we signed a contract Monday afternoon, and the deal was done. So it took us 4 business days to close that deal. So that's one of my favorites, not because, it is an exceptional property, but because we executed that transaction seamlessly. So that's one of the favorite deals that we've done recently. And then the second property that I really like is a $20 million property down in Melbourne, coincidentally, and it was a leisure centre. Yeah. So there's YMCA leisure centre there, and then there's a paintball grounds there towards the back. The reason why we liked the deal was because again, it was really undervalued. It's about a 26,000 square metre site and a 10,000 square metre building. So at $20 million, we're only paying about $750 per square metre on land with improvements. And the net income on the property is about $1 million net. We surveyed the area. Everything else was selling for about $1,000 per square meter land values. Land value is about $1,000 per square meter in that region. So we've bought something at 25% off land value with improvements, with $1 million net profit going into net income, beg your pardon, going recurring income. On top of that, we analysed the rental income, and we recognise that the tenant is probably paying somewhere between 60 to 80% below market rent. Market rent, based on our research analysis, should be somewhere between $1.7 and probably $1.8 million net. So we knew there's massive reversion opportunity in the next few years. So we're basically buying this property at massive discount based on land value, with improvements and potentially a 68 to 80% rental reversion in the next few years. So that's another deal that we really liked. That deal in total, took us about 60 days to close because there's a lot of due diligence involved in that property. And, the diligence alone, it took my team probably about 3.5 weeks to complete. Property. It was a big property. There's a lot of lease and subleases in there. So, we put in probably like 40 hours of work just on a DD for that property. But it was great. We ended up getting a really good result.
Yeah, not wrong. The reversion on that's going to be huge. It's huge. A great property.
Yeah.
Yeah, no, that's good. And tell me a little bit more. So you've recently launched your Property Lions Capital Fund, which is exciting, with your first acquisition now underway, and that was a very good buy as well.
Yeah.
The valuations coming in high. Tell me more about the fund and that purchase.
Yeah, great. Like you said, the valuation came in a few $100,000 more than what we paid for the property.
Great.
Yeah, so that's a good start. Very, very good start. And obviously you helped us a lot putting the finance together with that. So we've had a lot of clients buy properties, obviously through us, and often they might let's say they might start with $3 or $4 million cash, and to buy a property, they've used up a majority of it, and they might have 5, 6, 7, $800,000 left over, and that's a bit of an awkward amount if you actually think about it from a property sense, because maybe you can buy another commercial property, $1 million, $2 million, whatever. But, or you park it somewhere, like it's a bit of an awkward amount.
Yeah.
So they still want to put that money towards property, but they're not able to now buy a $5 million property with $600,000-$700,000. So a lot of these clients come to us and say, hey, Will, like, what else should we do? What else should we do? I said, well, you know what? Why don't we just group you guys together? All right. And then we'll put a syndication together or a fund together, and then we'll buy properties for you guys in that arrangement. And they love it. So the deal that we committed to was a $5.25 million property. It was actually two properties side by side, two factories. We put in about $2.8 million of the investors' money. So they all came up with roughly $900K each, roughly speaking, and then the rest was financed. And so we had a lot of success delivering that deal. The deal itself looks very promising because, again, there's a massive rental reversion in about 2 years' time with that property. We bought it on a 5% net yield, which is okay. But after reversion, we're expecting about 8% net yield after reversion. So that's a massive upside. So the clients love that. And so off the back of that, other clients have started to learn what we've done and say, hey, look, we'll be interested in the next syndication deal because, I have a super fund that's got $1 million in it, or, a few $100,000 with it. Again, not sure what to do with it. Maybe I can just, park the money into the syndication. Great. Or they simply say, look, I don't have a big enough budget to buy a $10 million property, because that's where the really good deals are. That's sort of up $10 to $20 million. That's the massive sweet spot there.
That's the good ones.
Yeah, that's where you get a lot of efficiency. So look, I don't have enough money to buy a $10 million property on my own, but I'd love to invest with other investors so that we can take advantage of those larger opportunities, which are typically more profitable. So we're hunting for our next deal at the moment. We've got something that we're negotiating on. It's circa sort of $14, $15 million. And you'll probably need to raise about $7 million for that. And, we've got investors that will be able to come up with that amount of equity. So we're pretty excited. So, hopefully we can identify other opportunities throughout the year. And put a lot of these investors together. The deals that we do follows the same philosophy. So we're still looking for value-add opportunities. So everything that we want to get our hands on, we want to make sure that there's an upside. So we're not here to put together a fund and have 8% distribution every single year. That's not what we're here for. The institutions call it core plus opportunities, which is basically opportunities with an upside.
Gotcha.
Yeah. And that's what we're focusing on.
Yeah, it makes sense. You've delivered so many times with the different individual investors. It's good now to have some of those bigger projects because there's less competition, or maybe a different type of competition on some of those larger properties as well, where anything under a couple of mil, it's a lot of people, mum and dad's trying to get involved. So if someone did want to come to you and purchase a property or learn more about Property Lions, how do they get in contact with you?
The easiest thing is to just go to our website, www.propertylions.com.au. I'm also on all the social media platforms. You'll find me on LinkedIn, Facebook, Instagram.
Posting regularly.
TikTok, YouTube. If you really want to look at our case studies in detail, we post a lot of it on YouTube. These videos I really break it down and I basically show all the numbers behind all the deals that we've done. So that'll be a really good place to look at the case studies. But if people want to go get in touch, just come to our website. There's our contact details there. Yeah, I'd love to have a chat.
YouTube's very good. You've got a lot of good resources on there and some really good detail. It's fantastic. Yeah. No, that's good. And to leave our listeners with a tip, are there any commercial property tips or investor tips, anything that you'd like to leave them with?
I think the tip that I would probably leave specifically for first-time commercial property investors is you have to spend the time doing the homework, because commercial property is very profitable, much more profitable than residential property. My mentor, he was worth $300 million. And, he only bought commercial property apart from his home and holiday home. And what he used to say to me is that if you want to play it safe, buy resi, but if you want to create generational wealth, go with commercial property. But you have to know what you're doing, because buying commercial property is like driving a Formula One car. It will get you to places a lot faster, but it's more difficult to drive. You need higher skill levels. And if you make a mistake, you can crash and burn. So for first-time commercial property investors, invest the time to understand the asset class that you're going to invest in. If you get stuck, talk to professionals. But really importantly, talk to professionals who've done it. So if you're talking to lawyers, talk to commercial property lawyers. If you're talking to mortgage brokers, talk to commercial property brokers. Accountants, whatever, make sure they have experience in that space. And once you've thoroughly researched and understand what you're getting yourself into, then go out and start looking at deals.
Yeah, fantastic. No, that's really, really good advice. Well, thank you for coming on, Will. It's been great to chat with you.
Yeah, likewise. Thanks for having me.
And I'm sure we'll speak again soon.
Yeah, sounds good. Thanks, Nick.